Good afternoon, ladies and gentlemen, and welcome to our halftime report. I will say, after 13 years of doing this event every year, this is a one of a kind. This is the first time we've been doing this event as a virtual event only, but welcome. I'm excited to be sharing with you our thoughts on the first half of 2020. For many of you who have attended this workshop before, this is something that we typically do in person. We do a forecast event, which we do in January or February each year, and then we follow that up with what we call our halftime report, which again, we typically do in person. And this year, because of the environment that we're in, we're going to be hosting it virtually. My name is Trevor Wild. I'm the Managing Director of Wild Wealth Management Group, and welcome to our halftime report. Like we always try to do, we put a theme to the event. This year's theme was pretty straightforward. It's been a crazy 2020, as you all know, and we subtitled this event An Unforgettable Year, and guess what, folks? It's not over quite yet. For those of you who have not attended this event before, we're going to go through three different kind of focus areas this afternoon. We're going to talk a little bit about the first half of the year. We put this together at the end of June, so most of July we spend focusing on putting this information together and the data points that have come out through the middle part of the year. So we'll talk a bit about where we've been. We're going to talk a little bit about where we are right now, and then finish up with looking at where we might be heading as we get through the back half of the year. Before we get into the meat and potatoes of the event, though, I would like to just take a few minutes to put some faces to some names, and I'm going to remove my screen here for just a minute and allow you to focus on the presentation. Also, for any of you who would like to have a hard copy of this presentation and the materials that we're providing here, please feel free to email me at info@Wild Wealth Management Group, and we'll get the slides emailed over to you, and you can have them for your reference point. So again, an unforgettable year, and it's not over yet. We've got a lot of information to get through in the next 45 minutes. This event will be recorded, so you'll have the ability to come back if you want to review things on your own, and we'll jump into it from here. So before we get into the meat and potatoes, though, I do want to take just a second to talk about my amazing team, not only of advisors, but our staff. Many of you on this call might be have been clients of our organization for 20 or 30 years. Many of you may be newer, but we always like to highlight our amazing advisor team that we've been building out here as part of our organization. We are proud of the diversity that we represent, not only as advisors, but in the diversity of the people that we serve and in you. So thank you for your continued support, and we look forward to continuing to drive that. Our client service team, again, an amazing group of people that keep our operation going. I will tell you, like all of us who have been dealing with the impacts of COVID and in particular running a business in this environment, I am incredibly proud of the job that our team, our advisors have done, especially in the last 4 or 5 months. It's been an incredibly challenging world. I'm happy to report that our staff and our advisors are healthy. We are working about 65% of our employees are working from home or on some sort of rotation. That might be as high as 70% depending on the week. And again, I'm just incredibly proud of our staff and all the things that they're helping us do this year. So you get to put a face with a name. I know many of the times you don't get to meet some of these people, and you're often talking to them over the phone. So hopefully this gives you the ability to put a little bit of a face with a name as we move forward. I did want to hit on a couple of things. I'm incredibly proud of the organization that we've built, and a few of the highlights for the year past are listed here up on the screen. Many of you who have been a part of our organization for many years have helped us achieve a pretty amazing ranking in Barron's. Barron's is probably known as one of the most common, for the financial publication world at least, one of the most respected magazines. Barron's runs a list of the top 1,200 advisors around the country. I'm proud to say that we've been on that list for 12 consecutive years, and in their February edition, most recently, we're ranked #1 in the state of Arizona, and that's truly a testament to our advisors, to our staff, and really a thank you to you, our clients. You have been incredibly committed to us as an organization, and we are proud to continue to serve you. A few other organizations, Wild for Arizona was a entity that we created a few years ago, primarily to focus on our community outreach. Many of you have participated in some of our events with Wildfire Arizona, from donations to actually donating time and energy. This year, and probably more than ever, our nonprofits here locally need us more than ever. And I'm proud to say that we've been active with Wildfire Arizona this year. We sponsored an event with Child Crisis Arizona where we fed more than 6,000 meals to local families in a kind of to-go style drive-through fashion. Again, we've made several donations to Child Crisis Arizona. I'm sorry to say that for many of you who, again, have been clients for many, many years, we host an event at the end of every year that we call our annual Zoo Light event. It's a wonderful event. We've been doing it for 17 years. This would have been our 18th year hosting this event. We partner it with a toy drive for Toys for Tots. Last year was our record year. We had the highest toy donation and cash donation to Toys for Tots that we've ever had. I'm incredibly heartbroken to tell you that because of the uncertainty in some of the contracts that we had with the zoo, we've had to make the very difficult decision of postponing or canceling the annual Zoo Lights event that we usually host at the end of November, beginning of December. We will still be doing our annual toy drive, and keep your eyes open as we will be sending communication out to all of you on how you can participate in that toy drive and what we are going to do. Obviously, we're going to continue to monitor the situation, and if something changes, then we'll reassess. That was a very hard decision, and for all of you who have made this a part of your annual holiday celebration with your families, I'm incredibly sorry to say that we've made this decision, but we do believe it's in the best interest of what we have to deal with, at least right now. I'm excited to announce some new team members. It's been a busy year for us as we've continued to build upon our staff, not only of advisors, but of client service representatives. We hired 3 client service representatives this year, Colleen Hanna, Jessica Olson, Allison Biggs, and a new Chief Operation Officer, Jackie Yoder. All were hired in the first half of the year. We're incredibly excited and thrilled with the improvements and what they're doing for us already. And we've brought on an additional advisor who works out of our Scottsdale office, CJ Deagle. Again, an advisor with a lot of experience and is a great addition to our team of advisors. We're thrilled to have them. We also have a handful of exciting things that we're working on right now that you will be seeing in the back half of the year. Now, obviously, with COVID and the inability for us to do educational forums in person and events like this, we've really turned our focus on changing the methods in which we can deliver education and continue to work with you to educate you and help make good decisions. A few of them are listed here. We do have a new logo and a new website that's going to be launched here in the coming weeks. A new webinar educational series, which is, we hosted our first educational series through webinar last month in July. The focus was Roth IRAs and the basics around Roth IRAs. But what we've developed is an educational series ranging from different investment topics to how to maximize Social Security, and we will be hosting an educational forum once a month, so keep your eyes open for invitations for that. And lastly, a new podcast that we're calling The Wild Wealth Way, which will also start at the end of August. So keep your eyes and ears open for some of these items as we get into the back half of the year. As always, our focus and drive here is to try to continue to educate you as our clients. We've always believed that the more educated you are, the better decisions we'll make together. So thank you for being a part of this. All right, so on to the meat and potatoes of where we've been, where we are now, and where we may be going. Like we always do, though, we like to start with a little bit of a brain teaser. And in true fashion of picking on the current topics of the world, we thought we would get you started with a few questions just to get your mind going about some of the things that are different in this new COVID-19 world. So the first question here is, which is a drawback to video game work meetings? As you all know, many, many people are working from home. A lot of companies have gone away from the traditional online meetings. So which do you think is a drawback to video game work meetings? Lengthy tutorials, having a posse ride and starting a gunfight, attendees getting bored mid-discussion and wandering off, or all of the above? Well, as some were polled, a participant actually in a poll recently stated, a perk of this is when you agree that a meeting is over, you can jump on a horse and do crime or justice. a lot less awkward than maybe sitting there with a fake smile on your face as this guy in the right hand is. Who DJs, this was a favorite of mine, who DJs a pandemic-inspired online pirate radio station? A high schooler, college student, parents of young children, or retirees? So again, the question, who DJs a pandemic-inspired online pirate radio station? So this was a station that actually came apart back in early March. Who do you think started this pirate radio station? The answer might surprise you. It was actually a group of retirees. The radio station is called the Radio Recliners. It's DJ'd by seniors who broadcast from their assisted living communities across America. And the tagline is keeping apart and staying together. Everybody's finding different ways to get through this. Now, many of you that are younger, or if you have kids who have children, you might be able to relate to this or remember what it was like to have young children. I know as a father of four, helping our kids get through this has been a challenge, not only from keeping their spirits high, but trying to keep them physically active. So there was a poll that was asked, and one couple asked an online community, said their 3 children had requested that at bedtime that the parents come up with one new and interesting fact each night at bedtime. And the parent needed ideas. So these parents went on to an online blog. Which of these facts do you think are true? The parents had to come up with a new interesting fact every night. So here's the questions. Which of these are true? Birds see ultraviolet as a unique color. Cats can be allergic to people. A blue whale's tongue weighs as much as some elephants, or all of the above? Well, if you guess all of the above, you're absolutely right. And lastly, one of the last questions, and this again was a bit of a fan favorite, and given what we went through, especially back in March, there's a new German company that developed a calculator during the pandemic. What do you think this calculator measured? Did it measure the number of song lyrics written to accompany hand washing, the amount of toilet paper needed during a pandemic, the amount teachers would be paid based on a parent's distance learning experience, or the ratio of ingredients for homemade hand sanitizer? All of these could have been it, but if you guessed toilet paper, you guessed right. And what we found, or what they found, based on this calculator, a person with a stockpile of 10 rolls of toilet paper who uses the typical amount of paper 3 times a day should have enough to survive for 53 days. So maybe back in March and April, the people that were hoarding toilet paper had good reason to. I hope that got your mind kind of stirred up a bit and had a little bit of fun. We want to talk a bit about where we've been, and there's no lack of events to talk about. We've tried to hit on some of the main ones that have been listed in the first 6 months of this year. And again, keep in mind, we put these slides together at the beginning of July. So all of this data is pulled through the end of June. There's not a lot of data here, but man, what a year where we had more events than I think any one of us would have liked to. Between U.S. trade, we came into the year with China trade tensions. We had an Australian bushfire, the U.S.-Iran conflict, coronavirus that started in China, the Royal Parliament, the impeachment trial, the death of Kobe Bryant, Britain exited the European Union, civil unrest in Hong Kong, COVID-19 declared a pandemic here in the United States, end of sports shows, concert shows. We're falling into a recession, and obviously the events coming into the summer of the U.S. civil justice protests. What an amazing year. And we didn't even mention murder hornets. It's just been an incredible year and a lot to get through. And we're going to try to touch on some of these events and things that have happened as we get through this. As the market pertains, and this is a chart, the blue line is the S&P 500 running from left to right. Right below that is the NASDAQ composite. What's interesting is at the beginning of the year, the market started in pretty strong fashion. We accelerated and actually hit an all-time high about February 23rd, right before the pandemic hit. So what did we see? We saw the end to the longest bull market in U.S. history, or maybe. We saw an 1,100-point drop in the S&P 500, and you can see that represented in the blue line when you go back to February, and a 2,900-point drop in the NASDAQ composite in just 30 days. From March 29th, when we hit that all-time high, about 2 days later, we fell into this pandemic pressure through March 23rd, an unprecedented drop. The NASDAQ composite hit an all-time high in February. We saw that incredible drop, and here recently we've seen the markets push back to all-time highs. We saw U.S. stocks after that drop in March post the best quarterly performance in decades, going back to the second quarter as the stock market hit an all-time low on March 23rd and rallied up from there. We also saw, and we didn't mention it here, we'll talk about it as we get through, one of the largest stimulus package in U.S. history passed right at the end of March in the form of the CARES Act. This was a really good quote. In less than 30 days, the market priced in a level of fear that has usually taken a year to reach, even during severe recessions. Now, it feels like a lifetime ago back in March when the markets did what they did. And it is amazing how quickly the things reversed, but the action at which we saw in March was incredibly volatile. And if you take yourself back, it was a very, very scary period of time. The fear and uncertainty spiked as COVID-19 spread beyond China. So again, what we have here in the red line is the CBOE Volatility Index, also known as the Fear Index. That's the red line. And then the blue line on the top is the S&P 500. And this goes back, again, you can see all the way back to 2008 at the far left. And you can see how low that fear index, in particular, in 2018 and 19, there was a few spikes that were generally happened at the end of 2018, beginning of 2019. But the fear index has been traded at all-time lows. You can see how quickly that reversed to the far right of your screen as the S&P 500 dropped in March and the fear index spiked. You can see how quickly that took place. And COVID caught the world completely unprepared. What we have here, and I know there's a lot of data here, is a picture of the entire globe. The dark red line represents essentially the higher cases. The paler shade of red, the fewer cases. So you can kind of see around the globe and see how the impact of COVID has kind of taken swarm of the world. The amazing thing here is you don't see many places where you don't see a deep red or a dark red. There's very few of the pale red shades around the globe. The fact is this came out of nowhere and the world was completely unprepared for it. As the virus spread, governments across the world implemented measures to flatten the virus curve as the pandemic started to happen. And the policy response, we saw this around the world, and you can kind of compare each one of the countries here in the chart to how they handled or the curve of the pandemic and the rate. But what happened, and we all know this, we saw school closures immediately. You know, I have 4 children that an 8th grader or my oldest finished 8th grade last year down to a 1st grader. And our kids started spring break on March 5th and never went back to school, even to today. We saw school closures, we had workplace closures, we had canceling of public events, restricted public gatherings, we had stay-at-home orders, public transit, and travel restrictions. And, you know, in talking to many of you, you know, everybody was impacted. You know, if you had trips planned, we had 2 weddings of family members that were canceled. And I know many of you have had events and fun things and family things that you had to cancel. The U.S. economy also shrank. You can see this is quarterly. This is GDP and real GDP numbers for each quarter. You can see from the left, we started at Q2 of 2016, and you can see pretty consistent growth with the exception of maybe Q4 of 2018. You can see here when you look at the far right of your screen, as we get out of Q4, which had growth, GDP growth rate somewhere right over 2%, real GDP fell for Q1 roughly 5%. Now, when we put this together, we didn't have Q2 numbers yet because we were just coming out of the second quarter, but those have since been released. What we saw in the second quarter was 8% drop in real GDP numbers. So we saw a 5% drop in Q1 and 8% drop in real GDP for Q2. That annualizes at about a 32.6% annualized drop in GDP growth. Again, these are historic numbers that have few seen before. Coronavirus policy slowed economic growth, and what you can see here, this is a map of the United States of America. The darker the blue, those represent states that went earlier, meaning they restricted economic activity, did shelter-in-place orders before March 22nd, and you can kind of see around the country how that took effect. There were very few states, many in the middle, that had either no shelter-in-place orders, but the vast majority happened very quickly. I also think that it's notable when you look at the dark blue states, so California on your left side, Illinois in the middle of the country to your northeast, and then New York on your far right, those dark blue states, those 3 states are humongous percentages of our GDP. California on average represents about 14% of our country's GDP. Illinois represents 4.2% of our country's GDP, and New York represents about 8.1%. So when you think about those three states, and those were the three early adopters of shelter-in-place restrictions, and still to this day some of the most stringent in the country, those businesses were shut down. And that represents, those three states represent somewhere around 25 to 26% of our national GDP. It's no wonder that we saw the hits to the GDP numbers that we saw in Q1 and Q2. Now, again, we talked a few minutes ago about GDP growth. The Atlanta Federal Reserve GDP, the now forecast, which this isn't an official forecast, but again, what was estimated for Q2, what they thought would happen for Q2 is they thought we would see about a 39.5% shrinkage, annualized shrinkage in the GDP for Q2. As I just mentioned, we've just gotten GDP numbers for the second quarter. Real GDP dropped by about 8%. The annualized figure was about 32.6, which was slightly better than expected. And again, as you look at these numbers and what happened with GDP growth, it is breathtaking. But what we are seeing is that the economy actually has continued to improve as we've gotten out of or through the second quarter. And you can kind of see this in the Atlanta Fed GDP now estimate on the bottom right. You can see what's happened in June and the spike that's estimated into July. We have to continue to monitor these. But we are seeing possible signs of an economic recovery, and we do expect it. And some of the things that we are seeing and we continue to see on the left-hand side, jobless claims are one of the most important things to see. And actually this week, so I'm recording today, it's Friday, August 14th, we had the new jobless claims reported yesterday. And what we saw for the first time since the second week in March was jobless claims under 1 million. Now, this is still a staggering number to say that we only had 900 and something thousand new people applying for unemployment claims is kind of unthinkable. But this is the first weekly drop below 1 million that we've seen since March. So this is a big, big deal. Financial markets obviously had a snapback improvement. We saw that in Q2. We do believe, and again, one of the things that's important to consider, and we talked about this on a lot of our calls, one of the big differences between this recession and what's happening now and other recessions like 2008 and 2009 is this is an event-driven recession. Our economy was shut down, mandated shutdown in early March to try to control the spread of this virus. Typically, not always, but typically what we see in these types of recessions is more of a V-type recovery. We'll talk about this as we get down the road a bit in the conversation. Mortgage applications have dramatically skyrocketed. I'm going to talk about interest rates a little bit later. If you're not looking at your mortgage, this is definitely something you should consider looking at. I'll talk to you about how we can help and where that is a little bit later. Consumer comfort, restaurant, airline booking are improving. Public transit ridership is improving. Electric demand. Some of the things that are not improving, to the right of this screen, new COVID cases actually spiked in July, especially here in Arizona. We saw this firsthand. The lockdown index, we'll look into this a little bit. Same-store sales have been flat, although just today and yesterday we have seen retail sales were better than expected, and we have seen some positive improvements as Q2 numbers have come out since we put this together. Oil rigs are still, the demand for oil is incredibly low, and steel production is still a problem. Let's touch on employment really quick, and this is still a massive problem. We're still, we're seeing improvements in unemployment, but it's slow. So if you look at this graph, the blue bar is U3 unemployment, which measures people who are unemployed and seeking work. And what you can see if you go back to March and April is it dropped from about 14.7 in April to 13.3% in May. The red bar, which is U6 unemployment, which includes unemployed, underemployed, which are part-time workers who want to be full-time or discouraged workers, it fell from 22.8% to 21% again from April to May. So we are seeing improvements in the slope of this. Now, the U.S. Bureau of Labor Statistics attribute the improvement to a little bit of economic certainty, but one of the biggest parts of this that we know impacted unemployment in April, May was a program that was part of the CARES Act called the Payroll Protection Program. This program offered loans to small businesses essentially so that they could continue to pay employees. And we also saw This was a big deal that happened. It was passed in March as part of the CARES Act. There was something like 5 million loans that were processed, and most of those dollars were delivered to businesses in April and May. So we know that had a tremendous impact. The purpose of that PPP program, the Payroll Protection Program, was to sustain employment for 8 to 24 weeks. So one of the questions that we have to continue to watch, as that effect burns off, what happens with employment. We've also seen improvements in manufacturing. So what we're looking at here is different manufacturing. Now, manufacturing, there's 18 industries that are a part of this index, and they range from food and beverages to computers and electronics and chemical productions, everything in between. Manufacturing, this is a big deal. The reason why manufacturing accounts for roughly 11% of the U.S. economy, okay? Economists track how business conditions in manufacturing are changing by looking at what's called this ISM, the Purchasing Managers Index. So the coronavirus, as you can see here when you look at the timetable below in February and March, obviously had a major impact in PMI. Sharp decline in February into March. And what you see as you head into May and June is that the PMI had a dramatic turn up and slope back to the upward side. The light gray line shows new orders, which have also been improving. So not only existing orders, but new orders that are coming in have been improving. This is a positive sign that we need to continue to watch. Consumer spending has improved, but personal income has declined. I don't know that that should be a surprise to anybody. The two lines that you see up here, the dark line is consumer spending. The light line is personal income. And what you can see, pretty steady, a slight decrease from January to February, but as soon as the coronavirus hit, we had a dramatic decline in both numbers. Not only consumer spending in the dark black line, but in personal income. Obviously, people are out of work. Now, one of the factors that we have to watch here that may have, and we know attributed to the increase in not only personal income, but maybe even consumer spending, is part of that CARES Act. The government had provided $600 in additional benefits for unemployment. And that was a huge impact. And on top of that, there was a $1,200 check that was delivered to most citizens. We know that that had a massive impact, especially in consumer spending and more importantly, probably in personal income as we got through March and into April and May. Now, one of the concerns here, as we've been watching play out here over the last few weeks, is that unemployment benefit, that federal portion of the unemployment benefit expired on July 31st and is yet to be extended by Congress. And just yesterday, Congress left their session and went on vacation without any deal. So this is something we're continuing to watch. This was a really good quote by Matthew Klein from Barron's back on July 1st. The problem is that the one-time payments have already been dispersed, and the enhanced unemployment assistance at this time was set to expire on July 31st. This quote goes on, even if hiring continues and wages keep rising, which is increasingly doubtful, as many states and cities roll back their reopening plans as the virus spreads, that means disposable personal income will abruptly fall 3 to 4% below where it was in February. So again, there's a lot of speculation of what's going to happen here as things go forward. The number of active business owners in the United States dropped dramatically also through February and April. And again, I'm not sure that this should be a surprise to anybody, but according to the National Bureau of Economic Research, the active number of new business owners, these are new people coming into business, starting their businesses, dropped by roughly 3.3 million businesses. And again, almost every industry was impacted. The only sector that we didn't see a decrease in new businesses was agriculture, which is just interesting. What we've done here is we wanted to show that how this is impacting different demographics, though, and different groups of people. And what you can see here is the massive hit has definitely been taken to unprecedented levels in these different groups. On a positive note, the personal savings rate has increased to a record high. So what this looks at, Axios News reported in April, says the savings rate was 33%. This is the highest since the Bureau of Economic Analysts started tracking the number back in the 1960s. Now, why is this, right? I think it's pretty clear. I hear it from my clients every day. We're not doing anything. We're not able to do anything. And I'm sure the uncertainty of the current environment is forcing people to rethink about their emergency savings account. And people are worried, so people are saving more. an interesting and a scary statistic all at the same time. According to the Federal Reserve, 49% of Americans did not have enough in savings to pay for a $400 emergency expense. Now think about that. What that's saying is half of Americans, if they were hit with an emergency expense, they did not have enough money in savings to cover a $400 expense. I think part of what we're seeing here with these savings rates is this has been a little bit of a wake-up call for Americans that we need to be a little bit more serious about how we save. Now, this is a little bit off topic, but I thought it was interesting, naming your account. So we've got a picture of Mosby over here. That's our family dog. But what we found is, according to growsacorns.com, Aaron Lowry of Grow said that if people name their savings accounts, they're more likely to stick to their ultimate goal. So on the left-hand side, here's a couple of thoughts. Uncle Sam. Now, you might say, well, what's Uncle Sam? Well, that might be someone's savings account for taxes. Honeypot, other people's weddings. That might be their kids' weddings or travel. And then the Mosby Fund. We got to worry about making sure the dog's got the vet bills to pay. 40% of people found it easier to save and to meet their savings plan if they name their account. So if this is something that you've struggled with and you haven't been able to maintain, maybe consider naming your savings accounts, and maybe you'll have a little bit more success. So that was a bit about the last 6 months in a very short period of time. We've had a lot going on, but where are we now, right? So here we are in the middle part of the year. Well, I think as Americans, we're trying to find ways to fill our time. Whether you're like me and many of our employees here where we have young kids at home and we're trying to keep them busy, or if you're retired and trying to be safe and careful, lots of people are trying to find ways to stay busy. One interesting thing that we found on Facebook is that there was a challenge issued by the Getty Museum in Los Angeles where they asked people to choose their favorite painting of all time and recreate it using common household goods. And I thought the results were rather impressive. Here we have a famous painting. We've got some clothes that represent the horse. Another one, pretty darn good impersonation of that famous painting. You can see what some people are doing here to save, to get by. Many of us, though, maybe after we're done creating famous paintings with household goods, have been stuck watching the financial media and the financial press. And it's been a volatile year. Q1 is the dark black line. Households is the light line there. And across the world, what we saw, the S&P 500 index, right now is down only about 3% through the end of June. It's actually coming back to about break even at this point. But what we saw in the first quarter was roughly a 20% drop in markets. And what we wanted to do is highlight kind of what really happened around the world. Generally here in the United States, whether you're watching CNBC or just the nightly news, the general focus is the U.S., is the S&P 500. The S&P 500 only represents about 500 of the largest stocks in the United States. There's a lot more than that. And even within the S&P 500, we didn't talk about this or put a slide together for this, but if you take out the three largest stocks that are part of that, the U.S. stock market goes from being flat to being down about 6 or 7%. But what you can see here, it was everywhere, right? Commodities were down 23% for the quarter, not from their high. And keep in mind, most of these markets hit an all-time high the middle part of February. And from their high, most of these markets were down somewhere between 35 to 45% from their high. For the quarter, you can see it was a very, very dramatic year and a very scary situation. The stock valuations got pushed higher. One of the things that we always talk about in our forecast events and these halftime is what is a PE ratio, price earnings ratio. The reason why the price earnings ratio we believe is important to monitor is this gives us an idea of valuation. Is the current stock or current price of the stock, is it high or low? And this is a method of, at least based on the earnings of a company, is it high or low? Now, one of the challenges that exists in today's world with the uncertainty of COVID is how do you forecast earnings? How do you know what a company is going to earn next quarter when you don't know if its doors are going to be opened or closed? So it's a very, very challenging situation. What you can see here on the far right, though, is the price earnings ratio jumped to about 29.22 at the end of the second quarter. Now, what does that mean? Well, a historic average of the S&P 500 is about 16.77, right? So if the average is trading price-earnings ratio, the higher the PE ratio, the more expensive the stock is. The lower the PE ratio, the cheaper it is from a price to invest. So 29.2% is a very, very high measure. Again, a large portion of that is the uncertainty around earnings. We also wanted to break this down by sector, though, because, again, everybody talks about the S&P 500 and it's kind of back to break even, but there's a very wide disparity on performance. You can see on the left hand of this screen, we've broken down the majority, the larger sectors that exist in our economy, everything from communication to utilities at the very bottom. Now, it is interesting that when you look at the areas that have improved or done okay this year, communication, consumer discretionary, healthcare, and technology in particular, these are all sectors, in particular communication technology, that had a boon from this. As I mentioned before, about 65% of our employees are working from home or are rotating from home. I can tell you our technology outlay has been more in the last 4 months than it has been in the last probably 3 years. We've recently had to replace our phone system. We've been moving people home. We've been upgrading their internet at home and improving and paying more for these services. Those are the outliers that have been positive. But if you look at everything else, consumer staples down 5.4%, energy down 31%, financials down 20%, industrials down 12%, materials 5%, real estate down 6%, even utilities, which are typically a safe place to be in a recession, was down 5%. Now, as would be expected during the first quarter of this year, the companies in the S&P 500 overall were less profitable than in 2019. Blended earnings declined by about 14.9% for the first quarter. Estimates suggest it will decline further in the second quarter as the majority of businesses were closed. Most analysts are forecasting that we'll continue to see improvements in the third and fourth quarter as we get through the back half of the year. Estimates for 2021 are also positive, and you can kind of see here this is by sector and different estimates, but ultimately the composite earnings for the S&P 500 index for the year is 28.8% for next year. Optimism about next year's earnings explain, you have to remember, the stock market, everybody's asking, why is the stock market where it is? The stock market is not looking at things today. The stock market has always been a forward-looking vehicle. It's looking down the road to trying to predict where we believe things are going to be, and that's reflected in today's stock prices. The hit that we saw in March was especially at the speed at which it happened, when the economy shut down, the market expected massive cuts and reductions in revenue, which is exactly what we saw in March and April as the economy was really shut down. As the economy reopened, we saw improvements in the markets looking forward. So it's important to think about that and to understand that the stock market is not a reflection of what's happening today, it's a reflection of what it expects to happen. Now, as we go, the stock market will adjust based on whether those expectations are actually met or if they're proven wrong, or it could even be the other way, where improvements, the market actually performs or the economy performs better than is expected. This is one of the biggest things that we all have to pay attention to, and at least we believe a major reason why we saw the spike in the turnaround in expectation back in April. And there's an old saying, my dad says it all the time, don't fight the Fed. What we saw in March in particular, and we've seen it continue as we've come out of March, is central banks have been very, very aggressive at providing monetary stimulus. And they've done it in a number of ways. They've done it through financial rescue packages here in the United States, the CARES Act. We've seen it across the globe. One of the things also is the United States has taken the interest rates back down to 0%. We're going to talk about that a little bit more with some ideas of what you need to look at. But again, and government on top of the central banks, governments have provided financial support too. Again, this is in the form of the financial packages. We've tried to kind of show you how dramatic it was. You can see in 2019, the pink bar is China, green is Japan, that yellow color is the Euro area, and then U.S. and kind of the orange. And if you look back at 2015, 16, 17, 18, 19, and even what was expected in 2020, the amount of government intervention, financial support was next to nothing. And even the 2020, what was expected, you can see, again, very, very little support. What you see there in the revised column, the far right column, is what actually happened was very, very aggressive. The United States has been incredibly aggressive. The CARES package that was passed back in March was a $3-point-something trillion package. Just to put that in perspective, in 2008-9, when we were coming out of the recession, the first financial package they put together was $800 billion. That package was $3-point-something trillion. So it pales in comparison to what happened before. Now, again, we're right in the middle of this. Most of the Congress has been debating a new stimulus package. Unfortunately, made the decision to go home to vacation versus getting something done. We'll have to continue to watch this. This is a quote from Fed Reserve Chair Jeremy Powell back in June. The burden of the downturn has not fallen equally on Americans. And we showed earlier that chart of new business owners by demographic and different groups. By and large, this has not been an equal downturn. And this was a quote directly from Federal Chair Jerome Powell. He said, as discussed in the June monetary report, low-income households have experienced by far the sharpest drop in employment, while job losses of African Americans, Hispanic, and women have been greater than that of all other groups. If not contained and reversed, the downturn could further widen gap in economic well-being, and the long expansion has made progress. It has not been equally distributed across the board. And looking at COVID, it's been the same thing. What we tried to identify here from a perspective of understanding it, based on the Brookings Institute, what we did, or what they did for us, is break down COVID-19 deaths rates by age and race. So we have 35 to 44 years old, 45 to 54, 55 to 64, and so on and so forth, and then broken down by white, Black, Hispanic, or Latino. And what you can see as the group gets older, the impact is heavier. Now, this isn't news for anybody, I know, but again, it's something we have to monitor because it could have economic impacts on what happens as we come out of this. Another great quote by The Economist back on May 16th, my birthday, earlier this year: governments and economic systems of all kinds have struggled to manage the pandemic effectively and equitably. But it does not take much imagination to see that if politicians allow the cost of things to born unequally, they could sow the seeds of a transformative populist backlash. I think it's fair to say that we're seeing some of that already. Yields on Treasury bonds. So let's move into the fixed income side. So amongst all this turmoil, this social and economic turmoil, Treasury bonds had moved lower during 2020 and edged higher. In June, as the number of virus cases increased, yields again retreated. You can see this on the far right of the screen. Another really great quote from Patty Dahm from CNBC: bond markets are moving with stocks. One of the very surprising impacts that we saw back in March, when the market was in panic mode, the last 2 weeks of the month, it wasn't just stocks that went down. It was stocks, it was gold, it was bonds. We saw every asset class with a small few exception during that 2 week period that moved dramatically lower. These are things we have to continue to watch. One of the things that we talked about last year in detail at this halftime report was what's called the inversion of the yield curve, which an inverted yield curve generally might suggest that a recession might be coming. The top line here shows the yield curve last June, so you can kind of see where we were at 2.5, where essentially you can see that yield curve. That top line is last year, and we're here. We are in recession. The National Bureau of Economic Research actually determined that the recession officially started in February of 2020, and maybe even at the end of Q4 of 2019 was the last full quarter of expansion. Since that point, we've seen on the bottom, we've seen the yield curve steepen. The black line on the bottom shows the current yield curve. It's flattened in the bit, as you can kind of see. It spiked when we came out of June from 0.49 to 0.6, and it's climbed up. But we are seeing that yield curve start to flatten out, which again, not always, but is sometimes indicative of what's going to happen. If we see that inverse, an inverted yield curve typically is saying that there could be a recession coming. We're seeing that flatten out, which could be a good sign. Many people, and we've talked about this for the last couple of years, bull market, the bond market, has been in a 40-year bull market. Many of you have heard of Jeremy Siegel. He's a professor from the Wharton School of Finance and probably one of the most well-known and well-respected economists out there. And this was a really great quote from him: 40 years of a bull market in bonds, it's really hard to turn your head around and say, could this be a turning point? But I think history will say yes. He says, I see rates rising continuously over the next several years. So this is something that we're monitoring. Now, obviously, while we're in the middle of this pandemic, interest rates are going to stay low, and we expect them to stay low. But as we come out of this and get on the other side of this pandemic, many people like Jeremy Siegel believe that we will see interest rates rise. Again, one of the things that you need to look at is you need to look at your mortgage again. If what we're seeing with mortgage rates, 30-year fixed traditional mortgages are falling into the mid to low threes. We have a client right now we do have an internal partner that handles mortgages and refinances, and I had a conversation with him 2 days ago. I have a client that's a VA, who's 100% disability as a veteran, and through the VA, he was able to refinance his house, and what he got, the VA has a streamlined program that he qualified for at a 30-year fixed rate at 2.4% with zero cost. We've never seen interest rates like this before, and they won't last forever. We don't think that they're going to go away quickly, but if you haven't looked at your mortgage, you need to look at it. If you need help, please contact us. Call your advisor. We have people here to help for this, but we do see an amazing opportunity if you have mortgage debt to reduce your cost and help improve that, and we don't think it's going to stay here forever. So where are we going, right? We covered the first few months of the year, a little bit of all the headlines that are coming at us. The year's not over yet, right? So this is a little bit of a chuckle, but as all of us are sitting at home, probably spending more time in front of the TV than we would like to, or maybe than we normally would. We've probably exhausted all the Netflix shows and watched every old movie that we could think of. But, here's the quote, wait, how many seasons is this? This just seems to keep on going. And right now we have more questions than answers, to be 100% honest. There is a lot of uncertainty about the near future, and here's just a few of them. We know that there is several drugs in stage 3 trial, but when will we see a vaccine? Will we see a vaccine? Will it be a therapy? Will it be a cure? As we head into the fall, will there be a second wave of COVID-19? And then even beyond that, even as we get on the other side of this, have consumer habits changed permanently? Have business habits changed permanently? One of the things that we're watching very closely is many businesses have the majority of their employees working from home. Will that stay, or will they bring them back to the office? Many consumers that normally would have never ordered a pair of shoes online and would have gone into a store to try them on have been forced to order stuff online. Will that continue to happen? Will business recover quickly? And ultimately, what will the shape of the economic recovery take? And just to touch on this, there's a number of historical methods at which the economy, which could happen. The black line, and we've talked about this on our conference call series, especially back in April, and we do believe that, because this is an event-driven type pandemic, as long as we can get on top of it with some sort of remedy, whether that's a vaccine or just something to help fight it, will be a V-type recovery. And that's so far what we've seen out of the stock market. It's clear what the stock market is expecting at this point. But you can see historically there's been a lot of different methods. The green line was an extended flat, and then what we call a W shape, where we saw the decline, a recovery, and then a second decline before we get out of it and on to recovery. We've seen U-shaped recoveries, which is the light blue. We've seen the L shape, which is what none of us are hoping for, which is we get this economic hit and things never really recover, or this square root shape where we take a massive hit, we see recovery, and then it flattens. Obviously, we don't know. This is what we're going to have to continue to monitor as we move forward. And then how about consumers? As I mentioned earlier, consumer spending is it's going to impact the economy or the shape of the economy. Some positives, the most recent consumer survey from the University of Michigan under the consumer sentiment showed that consumers are still uncertain about the future, obviously. The index of consumer expectations focuses on 3 areas, including how their personal income, their personal financial prospects are they going to be good or bad, prospects for the general economy and over the long term, and then prospects for economy over the near term. And in June, the index of consumer sentiment was at 78.1%, what you can see there. Now, we actually had a pretty big month-over-month improvement from May. It went up by 8%. But you can see a year ago, that same index of consumer sentiment was 98%. So we saw a dramatic decline. Again, I'm not sure that this should be of any surprise. I don't know about you, but as a consumer myself, and I ask myself these questions with all this uncertainty, it's hard not to be a little pessimistic about it. When asked about current economic conditions, it was better. 87.1%. We saw, again, a 5.8% month-over-month change. But again, year over year, a massive decline. And then the the index of consumer expectations, again, a very low figure. We are seeing short-term improvements month over month, but still nowhere near where they would be in positive economic times. So, will the consumer change the way that they spend? We talked about consumer saving right now at an all-time high. I guess there's some really good stuff behind that too. With consumers saving like they are, one of the things that's anticipated, if we can get on the other end of this with a vaccine or some sort of remedy, consumers have the wherewithal to spend money. And like a lot of you, many people have canceled things this year that they still intend to do, right? So the question will be, does that come back in 2021? How quickly, or is it delayed into 2022? It's not just COVID-19. As we covered before, COVID-19 is not the only issue that could affect or will affect the economic recovery. Political frictions are increasing, not only in tension between us and China, the United States and China, but trade, technology, restrictions on TikTok, you name it. We still have a lot of global political issues that could and will probably impact how the economy improves as we come out of this. A really good quote that we found from Neil Shearing, from the group chief economist, and this was just a really good quote: an important issue that is already facing governments and central banks is how to calibrate the removal of policy support as lockdowns are lifted and workplaces reopen. The most pressing aspect of this is how to taper employer subsidy programs without causing a huge spike in unemployment. You can read the rest of the quote, but we're seeing this right now in Congress, right? One of the big debates and issues that's being forced or looked at, or should be being looked at, is, we have this federal unemployment, the $600 that was approved, that ran out at the end of July. Congress has been battling back and forth on a couple different packages, and one part of that package was some sort of continuation of unemployment benefits. Again, Congress, unfortunately, just yesterday, on Thursday, August 13th, decided to leave and go to vacation, and they're saying now they're not going to pick it up until the end of until September. President Trump put into effect an extended unemployment benefit of $400 by executive order to hopefully cover people on the short term, but we're seeing it right here in our own backyard. These are going to be big things that we have to continue to monitor and to watch as we get through the back half of this year. Another really great quote is, we like to kind of tailor this down at the end. We like to pull some quotes from well-known research analysts with things that they're watching as they come into the back half of the year. Again, another one here that has to be watched. And this is specifically subject to the election that we're getting into here in the United States in the fall. The election puts a self-limiting factor into the equity rally. And in his thoughts, I quote, either the market sells off in the short run to register the current likely victory of Joe Biden, who will hike taxes, wages, and regulation, or the market rallies all the way till the election, increasing the chance of President Trump's re-election, which would revolutionize global system, especially on trade, and would require a sell-off around December. Again, just one analyst's thoughts and perspective. Again, incredibly uncertain period, very hard to predict what will happen. Another really good one from Liz Ann Sanders. One of my concerns is investor complacency. Bred from the stock market rocket launch off the lows back in March, there is no shortage of catalysts for consolidation and or a period of heightened volatility, including second waves of viruses, second order lasting economic shutdowns, simmering tensions between the United States and China, budding election uncertainty, and of course the civil unrest on the heels of the death of George Floyd. Again, and this is a concern that I think is shared amongst our group. In our investment committee, we talked about this. One of the good things, it was nice to see that the markets rebounded so quickly out of March, but unfortunately for a lot of investors, my dad always talks about having a healthy fear of investments and a healthy fear of the markets. The markets have been so strong for the last couple of years that a lot of investors have lost their healthy fear of the markets. When March happened, that fear came rushing back in and forced investors to remember that things are not always good. Markets do go up and down. The concern that she's expressing, and our investment committee's talked about this, is the rally, the rebound was so quick. And because of that, thank goodness, the pain was not felt very bad. That again, it kind of bred complacency, which is what she's saying here, that the average investor has become very complacent. And because of that, we do believe that the markets are susceptible to a heightened level of short-term volatility. It doesn't mean that it's going to stay down, but in particular, as we get closer to the election, I believe we need to be prepared for volatility and maybe more emotionally than anything else, because just like in March, if you reacted, it was probably the wrong decision. And it happens to everybody when we get in these times. Our focus here with our investment committee is we are monitoring and looking for ways to, in particular for our retired clients, and as I've said on our calls earlier in the year, we have to think about what we do for you differently. Our clients that are in retirement or near retirement, we have to handle very, very differently. Our clients that are in their 30s or 40s or early 50s that still have 15, 20, 25 years, we want to be looking more opportunistically. But our focus is to maintain balance and try to make strong strategic decisions based on where we believe things are headed and to maintain that balance without making a guess on one end or the other. We've gone through an incredible amount of information here in a very short period of time. I hope it's been beneficial for you. I want to leave you with one final thought. No matter what the future holds, we truly believe, I believe, the fundamental investments have not changed. And while it's tempting, and we all do it, we're spending so much time in front of the TV, and the TV and the information that's coming through is so hyper negative that it is easy and tempting to react to the information that we've seen, especially given how volatile and scary things are. And the overriding emotion is to go to cash. But it's rarely the right choice. We've been proving that again in March, that we have to stay committed to the strategy and to the balance that we have. I thank you for your attention today. We are excited to continue to help you as we get through this environment. I'm going to turn my camera back on here so I can say goodbye. But again, I want to thank you for your support, not only of our organization. I'm so proud of our team members and our advisors as they've handled themselves and as partners as we've worked through this together. I'm proud to serve you. We are proud to serve you. If there's anything we can do, please let us know. Again, keep your eyes and ears open for some of the educational forums. They will be all virtual on the back half of this year. And we look forward to seeing you again in person sometime soon as we get on the other end of this pandemic. Again, thank you very much. I hope you and your family are safe and healthy, and we look forward to seeing you sometime soon. Thank you very much and have a great day.